So now we're going to take a look at notes receivable. Okay, so a notes receivable is when the company receives a promissory note. So someone is going to pay the company back a loan, and they're going to pay the amount plus interest. So if we're talking about a note receivable, the company is the lender, and the company is owed a dollar amount plus interest. And so the way we calculate interest, we know interest is stated in terms of a rate, a percentage rate. And so to calculate the amount of interest on a note, we take the principal, which is the amount of the note, times the rate. And because interest rates are stated in terms of an annual rate, we'll then multiply it by the time. And so the principal plus the interest added together is called the maturity value of the note. And so some reasons why a company might have a note receivable: perhaps they loaned cash, but kind of what we're going along with what we're talking in this chapter, probably a more common reason would be is if they had a customer who was not able to pay their bill and they need more time. The company might say, okay, I'll give you 3 more months. Sign this promissory note. You have 3 months to pay, but now you're going to pay me interest for those 3 months. So let's take a look at an example. So let's say the company received a note because they loaned cash to somebody. So in this case, it's a 3-month, 10% note for a loan of $3,000. So if this is the case, we'll debit notes receivable for $3,000 and credit cash. Let's say we received the note in payment of an accounts receivable because the customer couldn't pay, so we had them sign a 3-month, 10% note, and they had a $3,000 accounts receivable. So we would debit notes receivable in this case, credit accounts receivable. So basically, accounts receivable is turning into a notes receivable in this situation. So then at the end of the 3 months, we would collect the $3,000 plus 10% interest for 3 months. And so let's take a look at how we would compute the interest, right? So interest is principal times rate times time. So 3,000 times 10%, 300 is a year's worth of interest. Okay? That's why we have to do the time. The principal times the rate is 300. We have to do the time because we're not collecting a whole year of interest, only 3 months. So we're going to take the full year of interest, we're going to multiply it by the time being, in this case, the number of months divided by 12. So times 3 divided by 12. So 75 is the interest for 3 months. So that's what we do with the time. We'll take, if it's months, number of months over 12. If it's days, it could be a 60-day note or a 90-day note. We'll take the number of days and divide that by 365. So we're going to be collecting the maturity value is the $3,000 amount of the loan, that's the principal, plus the 75 in interest. So we'll be debiting cash, $3,075, crediting notes receivable, $3,000, credit interest revenue for $75. Okay. And so that's what we hope happens. But sometimes, especially if you have a customer that's having trouble paying on their account, you get to the maturity date and they still don't pay you. This is called a dishonored note. It might also be called a defaulted note. And so when that happens, okay, we're going to, instead of debit cash, we're going to debit accounts receivable for that maturity value. Okay, because now we're going to have to go back and we're going to have to collect from that customer. So we'll debit the accounts receivable, credit notes receivable for the face value, the principal of the note, credit interest revenue. So if that $3,000 note was dishonored, instead of debiting cash, we would debit accounts receivable for $3,075, and then we'd go back to the customer and have them pay tell them, hey, you still owe us $3,075, and the clock is still going to be running on interest. Now they're going to have to pay us interest on $3,075. And so a lot of times in the note, they will state the interest amount if the note is dishonored, and a lot of times it's going to be higher than what the original interest rate was. When the customer eventually pays, we'll debit the cash for the maturity value plus the interest on the maturity value. We'll credit the accounts receivable, that would have been for the maturity value of the note, and then credit interest revenue. And the interest revenue would be calculated on the maturity value, would be the principal, times the rate, times the time. And the time will be from the day that the note was dishonored until the day that the note was actually paid, the amount was actually paid. So here's an example. After 1 month, the customer pays that 3-month, $3,000 note that was dishonored, but the interest rate after it was dishonored jumped to 12%. So if that's the case, $3,075 times 12%, oh, actually I don't have the time in here, times, it took 1 month, so times 1 divided by 12, right? So if we go 3,075 times 12% times 1 divided by 12, because it took 1 month after the maturity date to pay us, right? So that's how we got to the 31. I rounded up. So we collected $3,106, that was the cash we would have received. Credit accounts receivable for the $3,075 that we had debited when the note was dishonored, and now we've earned an additional 31 in revenue between when the note was dishonored and the month later when the customer actually paid us. The other thing we want to look at is accrued interest. And so we did mention this back when we were talking about adjusting entries. So the journal entries I was telling you about collecting on the maturity date, that was fine if the promissory note was received in one period and paid in the same period. But if we receive the promissory note in one period and the maturity date isn't until the next period, okay, we can't wait until the maturity date to record the interest revenue, because really every day that goes by on that note, we are earning interest revenue. If we wait until the maturity date to record the interest revenue and the maturity date falls in the next accounting period, that means all the interest revenue is going to be reported in the next accounting period. And some of that interest revenue was earned in this accounting period. So we are going to have to make an adjusting entry to record the portion of interest revenue that was earned in this accounting period, right? So we learned back in Chapter 3 when we talked about our adjusting entries that interest revenue, that when you make an adjusting entry, you're recording either an expense or a revenue. Well, in this case, we're recording a revenue and it's interest revenue. That's going to be our credit. We're not going to receive it until the next accounting period, so that means we are owed interest. So our debit is going to be interest receivable. And so the amount of this adjusting entry, principal times rate times time, and the time will be the number of months or the number of days. Well, let's talk at first months. So the number of months from the date of the note until the end of the period divided by 12. Okay. If it happens in the middle of the month, then you have to do days. So it'll be the number of days from the date of the note until the end of the period divided by 365. And then in the next accounting period, when you collect on the note, we'll debit cash for the maturity value. We'll credit notes receivable for the face value. But then we need to credit interest receivable. That's the amount from the adjusting entry. Okay? Because at the end of last period, we made an adjusting entry saying that we were owed this amount of interest. Well, now we're not owed it anymore when we collect it. So we'll credit the interest receivable, and then the interest revenue will be the amount of interest we earned in this accounting period. So the principal times rate times, and the time will be the number of months actually this should say, let me change this. This is better. It'll be the number of months from the beginning of the period until the maturity date. divided by 12, or number of days from the beginning of the period until the maturity date divided by 365. So let's take a look at an example. And actually, this is going to go back to some Chapter 5 stuff. So let's say we sold 10,000 merchandise on account. The cost of the merchandise is $7,500. Debit accounts receivable, credit sales revenue for 10,000. And then we have to make a second journal entry to update merchandise inventory. We debit cost of goods sold. We credit merchandise inventory. That's when we make the sale. And probably gave them credit terms of, say, 30 days. So we would have expected to be paid sometime in October. Well, November 1st, they still haven't paid us. So we had them sign a promissory note. So at this point, we received a $10,000, 6% 5-month note because our customer couldn't pay on account. We debit notes receivable. We credit accounts receivable. So it's a 5-month note. We gave them 5 notes. So that's November, December, January, February, March. They don't have to pay us until April 1st. However, December 31st is our fiscal year end. We can't wait until we receive that interest, when we receive the maturity value on April 1st, to record the interest revenue. We have to make an adjusting entry to accrue the interest from November 1st until December 31st. So we've earned the revenue. We have to debit interest revenue. We're not going to get it until April 1st of next year, the next accounting period. So it is owed to us as of the last day of our fiscal year. So we debit interest receivable. And then the way we figure out the amount, we take the principal, 10,000, times the 6% rate, and then we're recording the interest we earned for the month of November and the month of December, times 2 divided by 12. So our journal entry is then for 100. We've earned 100 of the interest on this note. Well, then April 1st is the maturity date. Now we're going to collect the maturity value on the note. We know the maturity value is the principal plus the interest. So 10,000 is the principal. We calculate our interest by taking principal of 10,000, rate of 6%, and we're collecting 5 months of interest, so times 5 divided by 12. Okay? That's how much cash they need to pay us. It doesn't matter that we've accrued 2 months already. They didn't pay us at that point. This is the amount that we should be receiving. 10,000 principal plus 250 interest. We should be getting 10,250. That's the maturity value of the note. So that's the cash we're going to receive. We're going to credit the note receivable, 10,000, because it's not owed to us anymore. Now they're collecting it. And then if we go back and we look at December 31st, we said we were owed 100 in interest. Well, now when we collect the maturity value, we're not owed that anymore. So we're going to credit the interest receivable for 100. And then we have to record the interest revenue that we've earned in this accounting year. So January, February, and March, we've earned 3 months of interest. So 10,000 times 6% times 3 over 12 is 150. So we'll credit interest revenue for 150. So we can see we've got a debit of 10,250, and in total we've got credits of 10,250. So that's how you record a note, the accrual of interest, and then the collection on the maturity date.